Intuitive Surgical just crashed 14% after beating earnings. Flash sale or valuation trap. I ran my latest blog post through Gemini Notebook for this quick automated breakdown. Check out my analysis.
Welcome to today's Explainer. We're jumping right into a pretty wild situation with Intuitive Surgical's recent stock performance and what it really means for long-term value. If you follow the medtech space, you already know Intuitive is an absolute titan. They're the powerhouse behind the Da Vinci robotic surgical systems. But recently, the market's reaction to their financials has left a lot of us scratching our heads. We're going to unpack the underlying health of the business, cut through the short-term noise, and figure out how we arrived at a highly unusual 33x forward valuation metric that emerged from all this chaos. Okay, picture this. A company totally crushes its earnings, right? But the market completely panics. The stock plunges 14% in a single day and ends up down 39% for the year. We're talking about massive, multi-billion-dollar drops in market cap over what basically amounted to very sensible, prudent guidance. Usually, when a top-tier stock falls off the cliff like that, your immediate assumption is that something foundational in the business model must have broken. But as we're going to see, the reality here is way more nuanced. Seriously, we have to ask ourselves, does this reaction make any logical sense? The management team prudently maintained their full-year procedure growth guidance of 13.5% to 15.5%, even after a stellar first half. Think about it like a sales target. If your team crushes the first half of the year, bringing in over half the annual goal, but you decide to play it safe and keep the original year-end target just in case the economy gets bumpy, you're being smart, right? Instead of praising the strong start, Wall Street essentially looked at that caution, called it an underperformance, and slashed the valuation. The disconnect is honestly wild. They grew revenue 19% year over year to $2.89 billion, and they surged their non-GAAP earnings per share by 28% to $2.80. Both of those numbers easily beat consensus estimates. And yet, Wall Street treated this massive earnings beat like a colossal failure, punishing the stock with that 14% overnight drop. It is a textbook case of market expectations completely detaching from real-world fundamental performance. The real irony here is how Wall Street completely missed the forest for the trees. They got totally fixated on a tiny little dip in U.S. procedures, dropping from 14% growth in the first quarter down to 12% in the second quarter. By reaffirming their full-year guidance around a 14.5% midpoint, management was basically just implying a 1% lower growth rate for the back half of the year, mostly because of tougher comparisons and seasonal effects. And that microscopic 1% tweak, that was enough to trigger a massive sell-off. So what actually caused that slight slowdown in the U.S. to begin with? Well, it's really just a temporary macroeconomic speed bump. It comes down to patients either losing insurance or facing higher deductibles. When Enhanced Affordable Care Act tax credits expire, or folks are pushed onto insurance plans with high out-of-pocket costs, they end up delaying benign, elective surgeries. It's a totally human reaction, right? You decide to live with the discomfort for a bit to save money. This absolutely isn't a structural flaw in Intuitive's robotic tech. It's just temporary friction in the broader U.S. consumer economy. And here's the absolute proof that core demand is definitely not dead. U.S. after-hours procedures actually exploded by a massive 26%. Why? Because maxed-out hospitals are running late into the night just to clear the administrative backlog. Patients can only defer necessary surgeries for so long. Eventually, they navigate their insurance or save up the cash, and all that deferred demand hits the operating room all at once. That 26% surge proves hospitals are running their Da Vinci machines nonstop just to clear the traffic jam. Now, Wall Street loves to panic over 3-month increments, but how does this short-term friction actually impact Intuitive's long-term story? The truth is, a business like this is built for a multi-decade runway. Yes, the U.S. market is in a bit of a digestion phase right now, but the long-term levers like shifting where care happens, international expansion, and unlocking entirely new types of surgeries are completely intact. In fact, they're accelerating. For example, to bypass those hospital bottlenecks entirely, Intuitive is aggressively moving into outpatient centers. They're taking older Da Vinci XR models, factory refurbishing them, and offering them at a huge discount to leaner ambulatory surgery centers. Add in their upcoming extended use program in 2027, which stretches out the lifespan of surgical instruments to drastically slash per procedure costs, and they're actively making robotic surgery cheaper than traditional laparoscopy. Their U.S. growth runway is far, far from over. Meanwhile, their international expansion is acting like a massive buffer. While everyone was freaking out over a 2% dip in the U.S., Intuitive has been quietly setting up the chessboard globally. They're securing regulatory approvals for their next-gen Da Vinci 5 across Canada, Europe, Japan, South Korea, and India. The international growth we're seeing now is mostly on older platforms. So once that new Da Vinci 5 hardware moves from regulatory approval into full commercialization in those massive markets, it's going to ignite a powerful new growth cycle. They are also brilliantly expanding their total addressable market. They aren't just doing the same old surgeries faster, they're unlocking entirely new, highly complex procedures that used to be impossible or highly invasive. The new Da Vinci 5 brings force feedback technology that paves the way for intricate heart surgeries. Then you've got their single port, or SP system, which uses hyper-flexible staplers to do complex hernia repairs and breast cancer mastectomies through just one tiny hidden incision. I mean, that is exactly how you widen an unbreachable competitive moat. Need a perfect example of that expanding moat? Just look at their ion system for lung biopsies. Those procedures surged a staggering 36% year over year in the second quarter. The ion system is quietly becoming its own multi-year compounding engine, generating recurring revenue before a patient even makes it to a standard operating room. It really highlights that Intuitive isn't just a one-trick pony relying on general hospital procedures. They're a diverse ecosystem of cutting-edge medical technologies. Which brings us to the valuation verdict. And honestly, this is where the story gets really exciting. Historically, getting into this deep moat business has been tough because it almost always trades at a massive premium. We're talking a long-term average PE exceeding 60x. Value investors usually love the company, but absolutely hate the price tag because the market prices it for sheer perfection. So when a stock that's used to trading at 60 times earnings suddenly drops 39% in a year, you absolutely have to pay attention. Let's do the math on that super conservative guidance. If we model out their targets of 14.5% procedure growth and a 68.5% gross margin, their projected fiscal year 2026 baseline earnings per share lands at roughly $10.60. But get this, they already locked in $5.30 in the first half, so landing at $10.60 assumes literally zero sequential growth in the second half of the year. That completely ignores their historically massive fourth quarter seasonal spike, making this a highly conservative, almost pessimistic baseline. Because the stock plunged to around $345, that $10.60 earnings baseline compresses Intuitive's forward PE multiple down to an incredibly rare 33x. This right here is the crux of today's explainer. You have a foundational medical tech monopoly, actively expanding its product lines and global reach, suddenly trading at nearly half of its historical valuation. A 33x forward PE for a company with this kind of moat is a scenario that almost never happens on Wall Street unless the business model is fundamentally broken. And, as we've clearly established, it isn't. It actually gets better. When you pair that 33x forward multiple against their projected 19% year-over-year EPS growth, you get a highly attractive forward PEG ratio of just 1.7. For a hyper-growth medtech stock, that is incredibly compelling. It essentially means that at 33x forward earnings, the price you are paying for the stock today is actually very well aligned with the aggressive speed at which they are growing their profits. Now, as they say, a shrinking multiple doesn't always guarantee a bargain. Sometimes a stock gets cheaper because the business is failing. That's your classic value trap. But there is a huge difference between a stock just getting cheaper and one offering real value. Intuitive's bulletproof balance sheet, lack of meaningful competition in core robotics, and their widening moat strongly suggest this is real underlying value. The earnings engine is structurally sound despite those temporary consumer insurance headwinds. So, while Wall Street's short-term fears linger, we leave you to consider, does this incredibly rare 33x valuation make this medtech giant an opportunity too good to pass up? The market panicked over a microscopic 1% implied growth moderation, punished a robust earnings beat, and handed us a fascinating valuation puzzle. The fundamentals remain strong, the moat is widening, and the price tag has been dramatically discounted. Is Wall Street handing us a generational buying opportunity on a silver platter, or is there a flaw in the robotic revolution they see that we don't? Thanks for joining me on this explainer, and I'll let you be the judge.